Hello everyone, let us continue with our discussion. So in the previous lecture, we have covered up the first 2 points, that is forecasting your fixed income returns and the emerging market, bond market basically risk. Clear? Now in this particular topic, we are going to study about the equity return and the risk premium approach. Now there has been one saying that if you look at a very long time horizon for the equity market for say 100 years, the data is not that meaningful, the data is not that reliable. Means if you purely based on the historical data and then if you try to forecast the future, then this data is not at all reliable. Clear? So in this particular situation, we are going to use the shrinkage estimator. What is the shrinkage estimator? We have discussed before that if I'm an analyst, I will use the historical data and also I will use the today's present scenario and my judgment. So I'll give the weighted average to the historical data. Suppose the weight of 30%, my judgment the weight of 40%, and the current market scenario the weight of say another 30%. Clear? Like this I am going to give the weight and then I am going to forecast the equity return. So I have mentioned these in my points as well. The same thing that if you look at the historically long-term historical return over the period of say 100 plus years, the mean real equity return across countries, they will look similar: developed, underdeveloped, emerging, like this. Clear? So they are not precise because equity return have high volatility. High volatility means the averages are less reliable. So in this situation, I am going to use the shrinkage estimator so that I'll have the better forecast. Clear? So what I am going to do, adjust the historical average towards the stable global mean. Clear? And my focus is to get more reliable information rather than just truly focusing on the raw historical data. Clear? Now, the first method which I have in my mind to be discussed is the discounted cash flow approach. Clear? I will forecast the future cash flow of the company. I will discount it and then I will calculate the intrinsic value of the equity and then I can calculate the return on my investment. Clear? So they are going to focus on the dividends. So they will look at the historical dividend rate as well as the present and the future dividend estimation. Clear? So with the help of this, I'll be able to estimate the value of a equity, or you can say the value of a company, and this is suitable for the long term valuations. Now we have the most common approach of DCF approach is the golden growth model, or you can say the constant growth model, because you are getting dividend say 3%, 4%, 5%. So there is some growth. Clear? So either you consider the golden growth model or the constant growth model. We have discussed about it a lot in our CFA level 1 and level 2. Clear? So if you are asking, sir, what is the growth of my organization, growth of the dividend in the particular company, what you will do, you will go and look at the nominal growth in the GDP. Clear? And that nominal growth in the GDP is the sum of real GDP growth plus inflation. Clear? But now you feel that the growth rate, the nominal GDP growth rate is 7%, but your index growth rate is say 12%. Clear? So accordingly, you will adjust the growth rate in your DCF model. Clear? Now, when we are moving one step ahead from the DCF and the golden growth rate model, we are coming to the Greenwald-Kroner model. What it says that? It says that, sir, what if you are repurchasing your equity? You are giving the cash to the shareholder, taking that shares back to the company. Then what is happening? If I'm looking at the earnings still increasing, but what is happening to earning per share? It is huge. Why? Because suppose you are earning $100 and you have say 50 shares in the market. So what is your earning per share? $2. Clear? But suppose now your earning have increased to 120 and you have repurchased the shares. You have repurchased the share 10 shares say. So now how many shares are trading into the market? 40. So now what is the earning per share? 3. So now you look at this figure, you have the increase of earnings is only 20%, but when you look at the earning per share increased by 50%. Why? Because of the share repurchase, because of the number of shares left in the market. Clear? So they are calculating this value through a given formula. So now let us write down the formula for the Greenwald-Kroner model. So the purpose is same, that we are forecasting the return of the equity. Clear? So expected return of the equity is equals to dividend yield of that particular company plus if there is any inflation. Clear? Plus real earning growth rate, real earning growth rate minus change in stock outstanding, change in stock outstanding. Clear? Because earlier my stock outstanding was 50 but now it's 40, so the change in stock outstanding is 10. Okay, plus the change in PE ratio, plus the change in PE ratio. My PE ratio is also changing, price per earning. Clear? So with the help of these information I will calculate the expected return of the equity. Now if I will redefine this term, that is your dividend yield, can you write it like this? Dividend divided by the price of the share, it is equivalent to dividend yield. Clear? Now this inflation is clear to me. Now this one can I write like this? Percentage change in earnings, percentage change in earnings. Similarly, percentage change in stocks plus percentage change in price to earning ratio. Clear? So I am redefining and writing this formula again. Dividend yield plus change in earning, it's in percentage, minus change in stock plus change in price by earning ratio. So this is the formula as per your Greenwald-Kroner model. Now if you look at this point, share repurchase means, that means your change in stock is negative. It reduces the number of shares which are there in the market and that will increase your earning per share as well as the return. Clear? Since it's negative and subtracting it, it actually adds, because this is negative. Now you are saying negative 10. So it's actually making plus 10. Hopefully you can understand this math. This one is negative already in the formula. Now minus 10 because my share moved from 50 to 40. So share reduced in the market is 10 shares. Clear? Now over here author have regrouped these terms. The first regrouping is dividend yield minus percentage change in stock. This is the first grouping. I am picking up these two factors. This is another grouping, and this is another regrouping, point number 3. So to this they have given the name as expected cash flow return. Expected cash flow return, or you can say income return. So now try to understand that earlier you are earning 4% of dividend yield, and now the company have repurchased the share of 1%. Clear? Company have repurchased the share of 1%. Now your next year, what is your income return or expected cash flow return for the existing shareholder? 5%, because they are getting this 4%. Now they will get this additional 1% because income is coming to the company. Now earlier it was getting distributed among 50 people. Now it is getting distributed among 40 people. So now earlier I used to get 4% income. Now my income is 5%. Clear? Expected cash flow return. So this is our first grouping. My second grouping is your expected nominal earning growth. This one. Expected nominal earning growth. That means how much your earnings are actually growing. Clear? And this one is your expected repricing return. Expected repricing return. Sir, earlier you were talking about the inflation, but now in this formula you have actually missed out the inflation. Sir, this one you have actually missed out. Now I tell you, I have actually not missed it out. It is actually presented over here. See, over here I have used the nominal earning growth, and over here I have used the real earning growth. So means this is coming from the two factors, real earnings growth plus your inflation. Clear? So if a company is suppose growing by 4% and the inflation is 3%, then what is the earning growth of my company? Nominal earning growth of my company is 7%. Clear? Are you clear? So over here, suppose I am making 5%. Over here I am making 5%. Over here I am making 7% growth. That means 12%. Now the third component is your expected repricing. That means your how much is the P multiple have increased in terms of percentage. Earlier my P was 6, but now my P have moved to say 5. Price to earning ratio reduced. Good for the company. Clear? Why it has reduced? Because of the denominator factor, that is your earning per share. Price per share divided by earning per share. Your earning per share have increased. It leads to the decrease in the P ratio. Clear? So now suppose 5% coming from the first factor, 7% coming from the second factor, 12, and suppose 1% is coming from the P factor, 1%, 13. So 13% is the total expected return on the stock market. Clear? As per GK model. As per GK model, how much my expected return on the equity? 12%. And I have considered almost all the factors: inflation, real growth of the company, dividend yield, stock repurchase, as well as the return on the PE ratio. Means how much PE ratio is also increasing. Clear? But again, the author is coming to the fact that Deepak, you have done everything. Okay. But now there is one important assumption to it. That important assumption of this model is that it assumes infinite time horizon. It assumes that the growth, the positive growth of the P ratio is for forever. And this is unrealistic. Your P cannot rise indefinitely. Clear? So for a very long term forecast, assume that the percentage change in the P ratio is 0 and the percentage change in the stock purchase is also 0. That is general scenario, because every time you cannot say that my P will always grow at the rate of say 1%. It's very difficult. Okay. So theoretically, which one is appropriate? This one. So this one is not appropriate. Your P cannot rise indefinitely. Clear? Now I have discussed the share repurchase. What if the company will issue the new shares? Now that will reduce the returns because the same income is now distributed among multiple public. Clear? And hence the return which I am generating will now be reduced. Write down, write down in your notes an infinite time horizon. An infinite time horizon ignores the fact that the PE ratio that the PE ratio would likely revert to its long term average Now over here, few things are easy to identify, like dividend yield is okay, expected nominal earnings growth is okay, share repurchase, you can understand it from the management's commentary. But this is something very difficult to estimate. That is how much there will be the growth in the PE ratio. Clear? So for the long term, you can understand that my PE ratio growth is approximately on the level of the long term average mean. But for the short term, it's very difficult to identify that how much it is going to be in the short term, say 1 year or 2 years down the line. But when I'll talk about 10 years down the line, then yes, you can understand that it's over a long term average mean. Clear? So in this point, what we have discussed is the three ways of calculating the return of the stock. Started with the discounted cash flows, we entered into the Gordon growth, and then the last one is the Greenwald Corners GK model. Clear? Now a very small point when I'm talking about the risk in the emerging market, equity risk pricing. Okay, when I'm pricing something, definitely there are few of the risk. Clear? Political risk, economic risk, currency risk, liquidity risk, corporate governance risk, regulatory risk, market structure risk. So we have studied them in detail earlier in our level 1, level 2 discussions multiple times. So I'm not spending time over there, focusing on the real aspect, that is the risk premium approach. Clear? So we are going to discuss about the equity risk premium approach. So what is this term premium means? Premium means above RF, how much you are going to get. And why you are going to get? Because you are going to take the risk, because you are investing in the equities. Clear? Or you can say in another way that equity premium is the amount by which the equity return exceeds the expected return on a default free bond. Again, whatever you are earning above RF is your premium, because you are investing into the equity, risk is coming from there, and hence you want the premium. Now, why we are discussing this point? The way we have discussed it in the fixed income, we are discussing it over here that okay, I have identified that the model which I am going to use to forecast the equity return. But sir, there are issues. Issues is understanding that premium. Okay, because forecasting involves the risk. So how you are going to understand that and how you are going to incorporate that? Clear? So I have assumed the financial model correctly, and they are going to give me the correct value for the securities. Clear? One model which we have studied before in the portfolio section, CAPM. Okay, that is actually used to estimate the risk premium. You remember? RF plus RM minus RF multiplied with the beta. Clear? What is this? This is nothing more than the risk premium. This is the risk premium only. Are you clear with this? So can I say risk premium multiplied with the beta? Risk premium is beta multiplied with the risk premium, because this is the generalized risk premium. But now I need to amplify that with the beta as well. If the beta of my stock is high, That means risk premium is also going to increase. Why? Because this is for the market. But this beta I need to incorporate for my particular individual stock. Clear? So what is this? This is market risk premium. Market risk premium. Clear? And when I'll multiply this market risk premium with the beta, what I'm going to get is the asset risk premium. Asset risk premium. Because I've used the beta of that asset with respect to the market. Clear? So can I say this is risk premium of the market denoted by RPM, and when you will multiply risk premium of the market with the beta, you will get risk premium of the asset. I denoted by I. Risk premium of the asset. So what CAPM presumes that I am able to invest in the whole market. Whole market means it includes all the possible investable asset available in the world. There I am investing into it. Clear? So the first approach is fully integrated market. Clear? Capital flows freely and the market is fully investable. You can invest in all the assets in the market. Clear? Now, this beta of the market, we have studied this before, okay? But still I am repeating this portion, is covariance divided by variance. Covariance between the return of the market and the return of the asset and the variance of the market. Hence you are going to get the beta. You are going to get the beta. Now I can replace the covariance with correlations. I can replace the covariance with correlation. So how it is going to be written? If I am going to convert it with correlation, then correlation multiply it with the sigma of asset, multiply it with the sigma of the market. So now I got the value of the beta. Clear? So now can I rearrange the CAPM formula? Can I rearrange the CAPM formula, or specifically the risk premium of the asset, what it was written? Beta multiply with the risk premium of the market. The risk premium of the market. Clear? Now can I change this beta term? What is this beta now? Beta is correlation, multiply it with sigma I, multiply it with sigma m, and further multiply it with the risk premium of the market. Are you clear till now? So now if someone have to read this formula, okay, from the understanding perspective, first of all look at, okay, let me rearrange it again. This portion, correlation multiply with the standard deviation of the asset. Clear? This is one section, and another section is risk premium of the market divided by the sigma m. Now hopefully you can understand this is nothing but a Sharpe ratio. RM minus RF divided by sigma. So this is nothing but the Sharpe ratio. And what is this? This is the correlation with the global market portfolio. Correlation in the global market portfolio multiplied with the standard deviation of the asset, and then again multiplied it with the Sharpe ratio. Clear? Of the global portfolio. So what is this? Risk premium of the asset is equals to the correlation of the global markets multiplied with the standard deviation of the asset multiplied with the Sharpe ratio. Clear? Now suppose I have few informations. Okay, few information like I have the value of the, I have one country X. Okay, so for that particular country I have the information with respect to their bonds, with respect to their equity. Clear? I have the information of their standard deviation and I have the information of their correlation. Clear? It is 10%, this is 15%, 0.40 and 0.70. Clear? And the Sharpe ratio is also given to you as 0.35. Clear? These are the information available with you right now. So now, can we calculate the risk premium for bonds and equity based on this information? The answer is yes. How to calculate the risk premium? Correlation multiplied with the standard deviation of the asset multiply with the Sharpe ratio. Clear? So let us start with the bonds. Correlation is 0.40. Clear? Standard deviation of the asset 10%. Sharpe ratio 0.35. So how much is the risk premium in the bond? Sir, 1.40%. Quite low. Okay. Sir, what is the risk premium for the equity? Then we will be able to compare. Because for the equity, risk premium needs to be high. Okay. Correlation 0.70. 15%. Sharpe ratio is same. 0.35. 3.68%. You see, the risk premium is higher for equity. Why? Because of these two factors. One is higher correlation, another one is the higher standard deviation. Volatility is high, means risk premium is also high. Clear? So this was the first segment which we have discussed. Fully integrated market, capital flows very easily. Second, the another approach, that is capital does not flow freely because of some barriers. Okay, government restrictions are there. That means there are two assets with the same risk but different expected return. But suppose there are two assets A and B. Clear? Expected return and risk. Suppose expected return is 16%, 18%. Risk is say 7%. Now tell me which asset you prefer. B. You have A. But the issue is that you cannot move to the asset B because there is a restriction from the side of the government that you cannot move from one country to another country or one asset to another asset which is in another country because of the issues with respect to the flow of the capital. So second approach is how to calculate the risk premium in that situation. So if I'll tell you, in reality, most markets, they are neither fully segmented nor they are fully integrated. Clear? No market is completely 100% free and no market is completely 100% segmented, that you have to remain within the nation. Clear? So now, suppose I am talking about my own nation now. I am not moving outside. So what happens to the correlations? Correlation between the asset of my country and the market of my country is going to be 1. Similarly, the beta between the asset of my country and the market of my country, again it is going to be 1. So what will happen to the risk premium? You see, what will happen to risk premium of the market, or you can say risk premium of the asset? Clear? The first component, standard deviation of that particular asset, multiply it with your correlation and multiply it with your Sharpe ratio. Clear? Now there is one more thing. If I'll rewrite this Sharpe ratio again, RM minus RF divided by your standard deviation. So this standard deviation will also cancel out each other. Clear? So what I am left with, only RM minus RF, or the risk premium of the market. Clear? So now I have said just now one thing, that there is no market which is fully integrated, which is fully segmented. Clear? So what I'll do, I will calculate two risk premium. One which gives me the answer for fully segmented and one which gives me the information on fully integrated. I'll take the weighted average of that and then I'll come to the final value. Clear? So the risk premium which is coming from the segmented one. So I will mention it as RPS. I will multiply to its weight plus risk premium, which is coming from the integrated one. Okay, I will write it as G, and then I'll multiply it with the weight, and then I'll come to the real risk premium. Clear? So just for your clarification, if you are calculating the risk premium which is fully integrated, you are using correlation, multiply it with the sigma of the asset. Clear? Multiply it with the market Sharpe ratio. Clear? And when you are calculating the risk premium when the market is fully segmented, then it is going to be sigma of the asset multiplied with the market Sharpe ratio. Are you clear? When these two informations are available, you can easily calculate the two risk premium, multiply them with the weight and add them together. Clear? Over here I have opened it up, so you don't have to fully open it up. Clear? So these two final formulas you need to remember. Clear? Means all those derivation which I have done before. Okay, starting from this one, no need. I have explained this just for the sake that you will understand the steps. What's important finally is this one. So we have successfully completed the portion of equity forecasting along with the risk premium approach and the emerging market risk portion till now. Clear? Now many students have asked the question, sir, do we need to calculate these risks in the exam? So the answer is no, because if you look at both the LOS, okay, LOS says that discuss the approach, and the second LOS discuss the risk faced by the investor in the emerging market risk premium. Clear? So nowhere LOS ask you to calculate, evaluate. Their main purpose is to discuss. But still, even if the question will come, I am prepared because I know the formula. Nothing beyond this is can come. This is the final thing. Clear? So with this, I am ending this lecture here. Thank you.